Welcome to this explainer where we're diving headfirst into a massive financial mystery that is unfolding right now across the global tech landscape. If you've been paying any attention to the markets lately, you know we are smack in the middle of this unprecedented artificial intelligence boom. But if you look just under the surface, there's this fierce, incredibly expensive battle happening, and it's catching some of the absolute biggest tech titans completely off guard. Today, we're going to unpack exactly what is going on and why some of the biggest names in the business are suddenly stumbling. Okay, let's dive into this massive paradox. Recently, Alphabet stock plunged by a staggering 6.9%. And, they weren't alone in this. Tesla also saw a dramatic 14.5% drop. Now, you might be wondering, in an AI gold rush, the pioneers shouldn't be losing money, right? So why are they? Well, the answer lies in what they just signaled to their investors: a massive, almost incomprehensible increase in capital spending just to keep up with the AI revolution. The contrast here is just stark. We're seeing established giants like Alphabet shedding market value, while pure-play AI startups are absolutely soaring. Take Anthropic, for example. This is an AI startup that Alphabet actually has a stake in, and their estimated valuation has skyrocketed to a staggering $124.3 billion. It's wild. The market is aggressively rewarding the pure AI creators right now, while heavily punishing the established giants, who basically have to foot the massive bill to build all the underlying infrastructure. So the crucial point here is that this AI revolution requires an almost unfathomable amount of capital. What's the price tag for this revolution? A jaw-dropping $811 billion. That is the exact amount Google recently reported in contracted future spending commitments. Honestly, that massive financial anchor is the exact reason why investors got so spooked, triggering that 6.9% stop drop we just talked about. But it really begs the question, where exactly is nearly $1 trillion going? Let's look a little closer at what all that money is actually buying, because this isn't just lines of code. This is a heavy industry arms race built on concrete, silicon, and copper. That $811 billion is going directly into three main pillars: hoarding highly advanced chips, building these sprawling state-of-the-art data centers, and paying for the sheer massive amount of electricity required to keep all those servers running day and night. You know the old saying, right? In a gold rush, the people getting rich are the ones selling the shovels. And hardware giants are selling the ultimate shovels right now. Intel just reported a 25% year-over-year revenue jump to $16.1 billion. That's their fastest growth in about 15 years, and it's entirely fueled by data center demand. Meanwhile, Nvidia locked in a $1.5 billion deal with Amkor for chip packaging down in Arizona. And AMD is pushing things even further. They just announced a massive 96-core Venice-X TPU for late 2027, along with partnerships with Cerebras for AI inference and the Eric Trump-backed Foundation Future Industries to supply chips for literal humanoid robots. But here's the catch. All those shiny new chips require an extraordinary amount of power. The physical energy demand of these AI data centers is so immense that entirely new coalitions are having to form just to deal with the fallout. Former U.S. President Donald Trump recently announced that 200 stakeholders, which includes 55 utility companies, have joined a voluntary pledge to protect everyday consumers from surging energy bills caused by these power-hungry data centers. So yeah, the AI arms race could literally show up on your monthly utility bill. But paying for infrastructure is really only half the battle here. The second massive financial drain dragging down these tech giants? A fierce global regulatory crackdown. Being a dominant player in tech today means you are under intense scrutiny around the world, and that scrutiny comes with a very, very high price tag, which just adds to the panic for those investors. For instance, if you want to know why Alphabet's stock is taking a hit, you have to follow the fines. The European Commission just hit Google with a massive €890 million fine. Under the Digital Markets Act, regulators determined that Google was illegally undercutting competition through its search dominance and the specific rules it enforces on the Google Play Store. So think about that. They're spending hundreds of billions on AI infrastructure while simultaneously bleeding nearly €1 billion in regulatory fines overseas. And the regulation isn't just about antitrust issues anymore. It's shifting into national security. Lawmakers in the U.S. are looking to establish some incredibly firm boundaries. Bipartisan House lawmakers have introduced what they're calling the AI Kill Switch Act. This proposed bill would literally grant the Department of Homeland Security the authority to shut down or intentionally slow down AI models that they deem to be dangerous. On the international front, the stakes are just as high. The U.S. Department of Commerce is actively investigating Chinese AI companies, such as Moonshot. They basically want to know if these foreign entities are illicitly accessing those highly coveted, advanced US chips to train their own competing models. It's really no longer just a tech race. It's become a matter of global geopolitical security. And because nearly $1 trillion is being sucked straight into the AI infrastructure vacuum, the rest of the tech sector is experiencing a brutal squeeze. We're seeing rapid restructuring and contraction as the collateral damage of this massive capital drain mounts up. Amazon just closed its Artificial General Intelligence lab in San Francisco amid wider layoffs. Patreon laid off 20% of its workforce, that's 93 people, citing profound changes in the creator economy. And the crypto exchange BitMEX actually announced it will permanently shut down entirely by September 2026.
Yet, while standard tech contracts, AI integration is seeing historic payouts. Massive deals are flowing directly toward AI companies right now. Stripe is reportedly in talks for a massive $10 billion acquisition of the AI model startup OpenRouter. The Pentagon just awarded a 10-year, $7 billion software consolidation contract to Oracle. And Anthropic, that $124 billion startup we mentioned earlier, well, they're integrating their powerful Opus and Sonnet models directly into connected apps like Gmail and Slack to completely supercharge their voice mode.
As all this tech bleeds further into your daily life, companies are fundamentally disagreeing on how to handle you, the consumer. On one hand, you have OpenAI rapidly expanding its ChatGPT health features, connecting to services like Apple Health for logged-in US users over 18. They clearly want AI tracking your most personal data. But on the other hand, Amazon is pumping the brakes, tightly mandating that third-party sellers must explicitly label product ads if they feature AI-generated humans. And these security and privacy issues are forcing immediate, real-world product changes. The tech is just advancing way faster than social etiquette or even the law can handle. Google is actually rolling out a global selfie video sign-in option that utilizes liveness detection technology to stop deepfake attacks dead in their tracks. Meanwhile, Instagram announced it's having to aggressively ban public pickup line and harassment videos that users are filming using Meta smart glasses. Over in the automotive consumer tech space, the landscape is shifting dramatically too, which is just compounding the woes for these legacy giants. Ford just announced that it will natively integrate Apple Maps into its new UEV line of electric vehicles. This fully replaces Google for its built-in navigation system. So when you combine an €890 million fine, an $811 billion infrastructure bill, and losing massive native partnerships like Ford to Apple Maps, well, suddenly that 6.9% hit to Alphabet stock makes perfect sense, doesn't it? And even our escapism isn't immune to this massive capital shift. The gaming and entertainment sectors are transforming just as fast. The European Commission just approved a colossal $55 billion buyout of Electronic Arts by a consortium that includes Saudi Arabia's Public Investment Fund. Microsoft is testing a free, ad-supported Xbox cloud gaming option limited to 1-hour sessions. And Amazon is integrating its Luna cloud gaming service directly into Prime Video, with Jeff Bezos pushing a major redesign to highlight the platform's new AI capabilities. So, as we wrap up this explainer, I really want you to think about this. Considering the hundreds of billions of dollars tied up in infrastructure, the rising regulatory fines compounding all these losses, and the massive physical energy toll at stake, is the current AI boom a guaranteed gold rush for these tech giants, or are they trapped in a very, very expensive arms race with no clear end in sight? Thanks so much for exploring this with me, and definitely keep your eyes on the data.